Hey guys, Bob and Phil here. Apple earnings just came out. We got problems, guys. Let's dive into this video and talk about it.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Okay, Bob, pretty concerning things here on Apple's guidance and revenue. Take us through it.
Yeah, so Apple last quarter, they guided down, the analysts did. Apple doesn't give any guidance, but they dropped their estimates down from like $1.57 a share to $1.09 a share. And so they really guided down on the revenue and the profit, and Apple still couldn't hit the lower estimates, Phil. And, if anybody's been trading for any period of time or an investor for any period of time, we know the analysts, their job is to sandbag. Their job isn't accuracy. Their job is to make sure that they get investment banking revenue into the shop, not showing how smart they are. And Apple couldn't do it. Apple could not squeak out enough sales to beat. And, they hit a high of 198. They're down to 190. Who knows what they'll be up tomorrow. But just remember, Apple is the market, okay? You can set everybody else aside. Apple's the one they throw all the money at to lift it, to move these daily moves in the market, and they couldn't do it. And look, if you look at operating cash flow for a second, I mean, you're looking at $26 billion. Let's just give them the benefit of doubt and let's say multiply that by 4. $100 billion in operating revenue for a company that's $3 trillion in market cap. I mean, you're looking at 100 years if you bought Apple at this price in order for you to generate the cash to pay for the company. And it's just absolutely absurd, and you give me all the whys and wherefores, but you wouldn't do it with your money if it was a private company, okay? Right. They just get away from it with this crap. But we've been waiting for this. Apple's struggling, consumers dead, Amazon won, but you got to remember, all these grocery stores and food companies have all been beating, Phil, because they're able to pass through higher pass-through costs on, need to have items. And so you have a situation like Palmolive beat, Coca-Cola had a great earnings call, so I wasn't surprised that Amazon beat on that side. But Apple is the one you're going to keep an eye on because that's the one that drives the indexes. And William Tell is rolling over in his grave right now, Phil.
Yeah, I think, iPhone, iPad, and wearables all missed. And like you said, this is an environment where the analysts have been sandbagging hard. I mean, look, Airbnb doubled earnings per share estimates. Amazon doubled earnings per share estimates. I mean, you're not really analyzing if you're missing it by that much, right? And but yet, we were thinking, man, Apple's probably just going to crush it. And turns out, devil's in the details. Product revenue down, and embedded in that is iPhone, iPad, and wearables, which is, everybody's got one of those three things, right? So I think there's a significant red flag here, which kind of plays into the next chart you dug up, right, Bob?
Yeah, is this the chart of death here? So
yeah.
so look, guys, I just wanted to just give you guys, this is really just mathematics, how these things work. And if you look at the silver chart of 2011, you'd see exactly what I'm talking about, is that this is really a steep Eiffel Tower effect. We've been seeing a lot of these in the market individually. We're going to see this with the S&P 500. And the mania phase was obviously the reaction to the pandemic. That money's rolling off, so we had basically a sell-off from there. And then we have what's called the return to normal, where everybody's talking about this is a bull market, you bears are idiots, always be bullish, blah, 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 blah. And that's what gets set people up for what they call the wave 3 for the Elliott wave heads out there. It's the big move down. And so usually retrace about 87% of the start of the bubble. And that brings us down. Basically, 1800 is kind of weird. 1800, I think, is where the floor we had going into the, I think, the year 2000 or the great financial crisis. It was the lows there, too. So 1800 is a big number. Mm-hmm. And I think that was the first, that's right, that was the first resistance after the move down to 666. on, I think, in 2008. So just keep an eye on that number. And, for me, I could see this out here in 2 years like this. That's how these things work. If people can't grasp it because they don't see these things like this, but just go look at other charts. This stuff happens. It happens frequently. And it's going to happen with this index too.
Yeah, you see this pattern in historic gold charts, and I think very similar to what Bitcoin did in the 2017 top into the 2019 bear market. So it's definitely a pattern, and the question, I guess, comes down to, Bob, will the Fed stomach a move that deep? Now that we're in this Fed driven, they're always there with the life raft type of mentality in this market, and we're just, politicians, it's just, you can never have a recession, it seems like, anymore. So that's the caveat, I think, in prior decades now, is we're so addicted to that easing, that QE stuff. We'll have to see if they actually come in to save the day, or if they say, no, look, we finally need to take our medicine. This is going to douse inflation once and for all. We get back to long-term growth. So that's, to me, the wild card.
Yeah, and I think your next chart answers the question, and I'll give you my perspective. These are state and local income tax receipts. I don't know if bull markets start or continue in this environment. I mean, this is, we're just being fed a bunch of garbage when they're telling us things are great. These tax receipts tell you everything you need to know. Is that people aren't making the money, the businesses aren't making the profit, the people aren't buying enough stuff. Property values are probably the only thing that's really county anyway. So it's a big issue. And the reason why I said this chart answers your last question is that everybody's going to be spending money like drunken sailors to lift the economy, because they're going to try to reinflate it, Phil. Mm-hmm. And they're going to need the bond market to not go off kilter. So I think they're going to do yield curve control. They're going to take money out of the stock market. They're going to force everything into the bond market. They're doing everything they can to keep the government Ponzi going. Mm. So yeah, I think it is different this time. I think they're going to sacrifice equities at the altar of government spending.
Right. And then, people will look at, I think income tax receipts is a huge tell. I mean, I think that is your leading indicator for a recession, because ultimately that will translate into a contracting GDP, which so far, this quarter GDP has been healthy, right? And I think you have also some disconnects with the job market, because there's such a shortage of bodies, it seems, with the job market. So you just have these job numbers that are looking strong, but the problem is, like, revenue's down, right? And you can see that in the tax receipts. The other thing too, people will point to is like, well, Amazon's having the best quarter ever revenue wise, right? Just blowing out earnings, blowing out revenue. But that kind of leads us to the next chart, right, Bob, which is our credit card delinquency rate. This is alarming too. I think this kind of goes along with tax receipts. And I think what we're getting is a little bit of an illusion as far as the retail consumer goes, because yeah, Amazon's blowing out, but at what, where's that coming from? I argue people are trying to maintain a lifestyle that technically they shouldn't or can't afford right now. And now we're seeing it on the credit card delinquency rate, because everyone's maxing out their cards.
Yep, that's right. And they are maxing them out. And you can see it. I mean, we get bombarded with 0% balance transfers constantly, right. And they're begging us to do it, and people have to do it. So yeah, I mean, this chart tells itself. I mean, look at this. Look at where we are in 2008 compared to where we are now. It's insane.
Right.
Yeah.
And this goes back to the early 90s, and we're just all-time highs.
Yeah, so look, you're gonna, once people max out, they're gonna walk away. Hey,
Right.
This next chart though, I want you to talk about it, because this is where the teeter-totter tells us whether we're gonna move up to 4,600 or we're gonna move down to 4,200 in the next 60 days.
Yeah, so here we are. We're trading on the SPX a little over 4,500, which has kind of been the short-term magnet level, right? And we really can't seem to get away from it to the upside, and that's why we have to watch now. If this Apple thing really put a bad taste in the market's mouth and we start losing 4,500, what you'll see there on the left is a big buildup of gamma. This is the options market, and just think of gamma as like a big magnet, right, for price. So the closer we start moving down towards the left there, and that's 4,200 SPX, okay, so that's about 300 SPX points lower. That starts to become a self-fulfilling prophecy that gamma gets energized and price will become attracted to it the closer we get. Subsequently, if the market digests Apple news and it thinks that, it's okay, then the options market's betting that we probably end up somewhere around a little above 46.50 or so on the SPX, which means we would see one final push higher, which is possible. But that's an interesting downside bet. And, personally, Bob, I think with this market so driven by like the reverse repo window, which is more of a recent phenomenon because we know these markets haven't always had a reverse repo window. And lately now that's just been so correlated to the market move. And the reason why the RRP, the reverse repo window, has been going down, right? Has an inverse relationship. It's been going down because of all those T-bill issuances, which is now gone. So I'm thinking that, they're thinking bonds are down, yields are up. That's all bearish for the market. There's no more T-bill fuel for the reverse repo. Reverse repo balances start to rise to seek that overnight repo yield, right? No more T-bill yields. So overnight repo yields pulls liquidity out of the market. And the options market is telling you that they think that downside bet, if it starts to roll over, so 4,500 is important on SPX, 4,400 is really important. You lose that, and then all of a sudden these downside bets at 4,200 are going to look real smart, and that's where you should probably expect this move to go before we see any kind of bounce.
Yeah, and Phil, just for our audience's edification, that line where you see the kind of like the bronze on the top and the metallic blue on the bottom, that's the point where there's equal amount of premium to calls and to puts. Is that correct?
Yeah, and that's why we've been kind of stuck around 4,500 SPX.
So what it means is that there are people making bets that the market's going to go higher through calls and sold puts, and there's people making bets that the market's going to go down with long puts and sold calls. And where that number averages in at, that's what's called the volatility wall. And when you start shifting, that wall moves, and that wall that's kind of like a magnet, and it's dynamic.
Right.
And so you could see here where the longer we go towards the end of this, these expirations that we see on that big, huge spike in calls, is that they start losing money for traders over time. These things aren't static. If you're not actively going towards that price, those calls lose value. And when they close them, it's closing the premiums and starts moving that wall to the left. And that's what Phil's saying. It's going to then magnetize towards the next big area where there's big blocks of puts and calls. So we start sliding down along those blocks of spikes as we get to the end. Well, it's dynamic, so there's always constantly new trades coming in the future. So that's what's fascinating about this. And this is what's been driving the market. If I'm not mistaken, Phil, right? This is the tail wagging the dog, right?
Nowadays, it's all about the options market. What we see on the index, S&P 500 and Qs and things like that, is all driven by what's going on in the options market. And so you're basically looking at the skeleton here of what pulls the levers.
Yeah, pretty fascinating stuff. So guys, look, the Apple trade, we actually didn't think Apple would miss this quarter. We thought the big miss would be the next quarter. But the fact that they didn't beat lowered expectations should be an alarm bell. And it bears watching for the long term. And with that, Phil, that's all I got. We'll catch you guys tomorrow. And hit like, hit subscribe, check out our service. We can help you be on the right path of some of these trades. So thank you.
And let us know what you guys think. With this information presented, do you think 4,200 comes, or do you think we ring the bell one last time up there near 46.50? Leave your comments below. We'll see you guys on the next video. Take care.
Trade Genius.